Hello and welcome to another edition of 9 to 5 Live. My name is Mark Williams, and joining me like every Monday is Francois Savary. Francois, hello.
Hello, Mark.
A few commentators, in fact lots of commentators, have noticed that the volatility in the markets, as expressed by the VIX and the MOVE index, has been creeping up and quite a lot higher than the average for the last few years. What are your thoughts on this? Why is this suddenly happening now?
I think you have different factors. The most important one and the one that we are all looking this week is the US elections. And that's one of the reasons why you have such a development, because you have people thinking about who is going to win tomorrow. And so that's something that is bringing back the kind of you want to protect your portfolio. And that's something that is quite important. The second element is connected, to my point of view, to the return of what we call the bond vigilantes, the one who are saying that, after a campaign that did not discuss the issue of public finance in the US, people suddenly realize that the development for the future are not going to be very rosy in terms of public finance for the American people. So this is one of the reasons that the 10-year bond is at 4.38 right now, and there was a huge tension in a matter of a few weeks. And we discussed this issue that we need to be careful with duration in such a context, and that's the reason why volatility is making a comeback. Then there is the issue also about the fact that there is a lot of, I would say, consensus on the fact that we are moving into a soft landing and that there is no other option than a soft landing for the medium term. And some people are saying maybe it's too consensus, and we need to be careful with that. And that's the reason why they are playing with volatility.
You just mentioned duration. Which part of the yield curve do you favor at the moment?
I think that you need to be in the short to medium. I said that you should not be in the long part. I think that there is still some risk that we go to 4.5, and you have some people who are telling you that we are going to go to 5%, because at the end of the day, the US economy is very strong. Depending on what is going to be put in place in terms of fiscal problem for the coming months, you have a risk that inflation could make a comeback.
Bearing in mind the upwards trajectory of the 10-year bond yield since the Fed announced their interest rate cut, this isn't obviously what they would have wished for. Do you think this is going to play a part in their decision-making process on Thursday when they meet and they will potentially announce an interest rate cut?
I would say that the recent economic numbers in general have been quite good, except for the number that we get Friday on the non-farm payroll, just 12,000 job creation, which was very low. At the end of the day, we are facing the next Fed meeting with the same kind of condition that we faced the last time they decided to go for 50 basis points, when suddenly they were disappointed by the non-farm payroll numbers, and it drove them to, and to my point of view, it was excessive, to cut by 50 basis points. Yes, it will have an impact. I don't think that they can do more than 25 basis points. I think that they will reflect a lot about the fact that they need to give the people a sense of there is a strategy. So it's going to be discussed. Do we not make anything? Do we make 25 basis points to show the people that there is a clear trend towards low rate in the US and that it is justified because now we have a control on inflation? Yes, it will impact the discussion, but to my point of view, it will be a 25 basis point cut by the Fed this week.
Just quickly, looking at gold. Gold is creeping ever higher. Do you think that's purely now driven by interest rate expectations?
I would say that when you look at the way interest rates are developing in terms of nominal interest rates or real interest rates, which are going up too, this is not necessarily something that is positive for gold. I think that at the end of the day, what you get into the gold price right now is really the safe haven status. As I said, you have the issue of public finance in the US. What is going to happen with a budget deficit that is so big, with the fact that the US needs to borrow 1 trillion per year per period, and that it's quite a lot of money that needs to in the future that is going to impact the situation of the US dollar. So there is a kind of safe haven status due to the public finance development in the US. And I think that there is a safe haven status connected to the geopolitical situation, which is still quite difficult, especially in the Middle East.
Coming to the stock market now, prices are very high, as we know, obviously. despite the upcoming elections and the geopolitical situation. But are, expressed in terms of earnings, are markets that much more expensive than they were 2 years ago?
They are not necessarily a lot more expensive than they were a few years ago. Nevertheless, you need to keep in mind one thing. We discussed at the beginning of this talk, we discussed about the fact that interest rates are going up. The long-term interest rates, at least, not the short-term necessarily. But the long-term interest rates are going up. This is not necessarily something that is very positive for equities, except, and that's a big except, if earning per share expectation by the consensus are satisfied in the coming 12 months. People expect EPS to continue to grow to close to 10% in the coming 12 months. This is a significant amount, but it is not unrealistic with the scenario of a soft landing. So that's, if you look in absolute, in a way, you could say the condition are satisfactory and you should not be too worried by the PE of the market. Nevertheless, don't forget that it is very much higher than the average EPS forward. Usually you pay the market, the S&P 500 15 times, we are closer to 22 times. So it is not an historical average valuation for the equity market. But then there is always a then. What you need to keep in mind is that the index today is very different from the one we had a few years ago. And you have those magnificent seven, which are leading the index, which are represents a lot of the index, and they produce a lot of money quarter after quarter, as recent earning season showed us again. And then there is a final element I want to mention. In relative terms, the equity market begins to be expensive, because when you see the bond yield rise the way it has risen in the course of the last few weeks, there are some investors who could consider that it becomes attractive. This is not my point of view. It could be attractive to jump into treasury bonds and to reduce your equity exposure, because the risk premium of equity has been reduced in the course of the last few months.
And talking of, you mentioned Magnificent Seven. There were some earnings results from some of the components of the Magnificent Seven last week, and some people were disappointed. Can you explain what happened and what your thoughts are on that?
Mainly, people were disappointed by the fact that, first of all, Microsoft has an issue that they showed that there are constraints that are appearing, and that it means that they will have to invest even more and more in order to satisfy the demand coming from the AI story. It was a little bit the same for the other Magnificent Seven. There is a fear, to my point of view, in the market, and we already experienced that at the Q2 earnings season. People were seeing that those Magnificent Seven are going to invest a lot of money, and they need to invest a lot of money to satisfy the AI innovation that we are in. The big question some investors are in their mind is it not too much investment? Are they not, at the end of the day, feeding a kind of frenzy or bubble in the AI story by creating capacity that at one point will be in excess to what is really needed? So there are some interrogation there. They are not necessarily correct, but this is something that you need to have in mind, because the numbers are huge. The amount of money those companies are investing are very, very significant.
Lastly, coming to Warren Buffett. Warren Buffett famously, he always says it and he repeats himself, he never times the market. He's not interested, he's just a value investor, and he just looks at individual stocks. He never looks at the value of the stock market at the time he's investing. However, he's reduced his holdings to a cash position of 300 billion, which is the highest ever, I think, recent memory anyway. What is he doing? If he's not timing the market, what is he doing? Why is he doing it?
I am not in the head of Mr. Buffett. I would like to, but he's a very smart investor. He has been a very, very successful long-term investor. When Warren Buffett is doing something, you always have to listen to it, because this is something that could be significant. Warren Buffett is not convinced that the market is a justifiable valuation. He believes that you don't have a lot of opportunity. You know, he's a value investor. He doesn't see a lot of opportunities. You know, at the end of the day, markets can go up, but going up is not necessarily a straight line. The big question, and to my point of view, the way I interpret the decision by Warren Buffett, he says at one point there will be some correction on the market. Doesn't mean that the trend is nonetheless going to be broken definitively and that the bull market is over. It's something that is fearful that there are all the reason to believe that some correction, and by correction I mean more than 10% fall on the equity market, could be justified to give some space to this market. So he's building a treasure in order to be able to find some opportunities then, and this has always been the way Warren Buffett has acted in the course of the last 50 years.
Thank you very much, Francois. I think that's all we got time for. Let's speak next Monday.
Okay, thank you. Have a good week.
Thank you for joining us. Bye-bye.
Bye-bye.